Hello everyone, welcome to today's US Open live session. It is Thursday, March 14th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. Commodities were once again in the spotlight as the International Energy Agency lowered its 2024 output growth forecast and raised it for demand, and this helps oil prices, while copper prices spiked to 11 months highs following news around China's production levels. And of course, just a little bit earlier, we had some economic releases from the US that actually put some pressure on Wall Street and helped the greenback. And of course, we have central bank bleeds next week, starting with a high stakes meeting by the Bank of Japan, which seems to be a live meeting for potential pivot. So this will be today's main themes. Before we begin, however, as always, please read carefully through the risk warnings and the disclaimers. Okay, let's get the ball rolling. We have quite a few things to cover. We're gonna start a bit differently today. We're gonna start with US oil. You can see rises and tries to set new 2024 highs. Then we're gonna talk about copper prices, which hit new 11-month highs, and then we're going to talk about Euro USD and the Nasdaq 100, which now react to some releases that we had earlier, but limited reaction so far. And we're gonna also focus on the incoming policy decision by the Bank of Japan and how this could play for USD JPY and the Japanese stock market. So let's go ahead with US oil. OPEC plus, or actually, oil prices have been rising this year, mostly due to flow disruptions from the war in the Middle East and the hostilities in the Red Sea. And unfortunately, we saw an escalation there with the first fatalities, unfortunately. And of course, OPEC had not long ago announced the extension of its output curbs into the second quarter. And today, the International Energy Agency raised its demand outlook and lowered the forecast for supply growth. Of course, this boosts oil prices, along, of course, with a decline we saw in US crude inventories. Now, that keeps the 84.9 handle in the spotlight. But as we have said before, we are a bit cautious around the ascending prospects, given that these are mainly due to supply disruption, and that has limitation on how far it can actually drive prices. Now, on the other hand, the International Energy Agency may have upgraded its demand outlook, but still forecasts a significant slowdown compared to last year, and expects non-OPEC plus supply to eclipse demand expansion by some margin, quote unquote. The world's top importer, meanwhile, China, continues to face economic headwinds, and policymakers remain reluctant to deploy bold stimulus. So that could create headwinds. Adding to the fundamental and macro headwinds, the relative strength index, let's bring that up. This is the relative strength index on the bottom. You can see that it is in overbought territory, the most overbought since the January peak. And also, US oil has failed multiple times recently above the $80 mark. So this creates scope for a pullback and a new breach of the 200 period EMAs in the mid 77s, which could endanger the upside bias, but further weakness, and especially below the daily Ichimoku cloud, does not look easy under current conditions. I would say that given this supply demand push and pull, it's hard to see sustained either prolonged gains or prolonged weakness, and the downside definitely appears to be well protected. Now let's turn our attention to copper prices, which spiked to 11-month highs after top Chinese smelters reportedly decided to cut production. Even though there was a lack of details, the news comes at a period of broader supply concern. Key miners like Anglo American and First Quantum have slashed their 2024 output targets, and the latter also halted production in its biggest site, the Cobre Panama, due to a court ruling. On the demand side, the clean energy transition and prospects for a recovery in the chip industry, largely driven by the artificial intelligence revolution, can put upward pressure in demand. Of course, copper is used on chips, is used on batteries for electric cars and other such technologies. Now, given the new highs, copper now has the 4196 handle in its crosshairs, but we remain cautious around further gains. With the RSI pointing to overbought condition on the bottom part of the chart, a pullback would be reasonable. However, daily closes below the 200 period EMA, the black line here at around 3860, that would hold the bullish momentum, would need a strong catalyst. Now, in terms of factors that could create headwinds, is that Chinese miners may have agreed to output cuts, but demand may continue to sag as the economic recovery of China has been uneven and the property sector remains in distress. And remember that copper is heavily used in home building. So that's definitely crucial and can create downward pressures. And with that said, let's turn to Euro USD. Of course, not to the Euro dollar, not many developments there. Just earlier, we got data from the US, the producer price index, which showed a significant increase, so plays into this sticky inflation theme, and drop in unemployment claims, which points to strong labor market. And this creates upward pressure for the greenback. Let's actually see that. You can see on the right that the greenback rises today after these releases, and on the left you can see the SPX 500 pullback again based on these releases. Now, back on Euro dollar chart, we see that it consolidates the recent gains. There is a pullback here. And this could continue due to the murky monetary policy differential ahead of the Fed's decision next week. The latest CPI data had shown stickiness again and don't make a Fed pivot any easier, but markets still expect 75 to 100 bps of cuts to begin in June. On the ECB side, President Lagarde had dismissed rate cut talks last week, but other members have pointed to summer cuts, and the bank lowered its inflation forecast, seeing the 2% target achieved in 2025. Now, the ECB's more hawkish stance has helped the pair to new 2024 highs, but stalls ahead of the 1.1017 resistance. And the common currency does not inspire confidence for much more at this stage, since the ECB may be a better candidate for a pivot given the weak economic activity. With the Fed having recently adopted the reserved approach around removing monetary strain, there is scope for a test of the 200 period EMA. And of course, today's data we just talked about also point towards a pullback. Daily closes below the 200 period EMA, the black line on the chart would pose the upside bias, but the downside contains multiple support levels, mostly the daily Ichimoku cloud, which expands up to all the way down to 1.079. Let's turn now to the Nasdaq 100. Of course, if there are any questions or opinions on what we discussed, feel free to type them in the chat box. Now, let's talk a little bit, not many changes on the Nasdaq 100 front. We'll cover that, and then we will talk about next week's key event, the Bank of Japan. Now, as we said, not much has changed on the Nasdaq 100 front. Inflation persistence and conservative Fed contain it, and along with today's releases, create scope for sub 200 period EMA moves, the black line on the chart, but sustained weakness below the February lows, 17,322, would require a sharp reversal in sentiment. Markets for now overlook any hawkish signals, and bulls are in control, ready for new all-time highs towards 19K. And one major driver, of course, is AI optimism, and there has not been any pushback against that either for now. And now let's turn to the Bank of Japan and how its policies have affected both the currency and the stock market, and how any pivot could impact those. The BoJ is heading towards normalization of its ultra-loose policies, as it appears increasingly confident that it will achieve the 2% inflation target in sustainable and stable manner, together with wage increases. That latter part is crucial. As you can see on the chart on the left, CPI ex fresh food, core inflation that is, has stayed above the 2% targets for nearly 2 years, and policymakers see it at a median of 2.4% in the fiscal year 2024 that starts this April. On the wage front, headlines around the spring negotiation are encouraging. While despite weak economic activity, the country actually avoided a technical recession. Base case scenario for next week's meeting, Tuesday, seems to still be not changed, but the meeting is live. April is a better candidate because it is also accompanied by updated projections and the wage negotiations outcome, but hopes for a pivot have been rising, and looks like it's going to be a close call between for next week's decision. There is also the question that when the pivot comes, what shape will it take? Other than exit from negative rates, what will happen to QQE? What will happen to the yield curve control? Further loosening may not have much point at this stage, but complete abandonment, or maybe something different, perhaps a different yield targeting. So there are definitely many questions. Now, we need to remember that the BoJ has kept this ultra dovish stance since 2016. You can see that there are negative rates since 2016. The QQE and the yield curve control were also introduced at that year, so you can understand the stakes of a pivot whenever this comes. This here, you can see it has been rising over the last couple of years and has risen all the way up to almost to the July 1990 highs. It's in has reached 1990s territory. And a pivot at a period when, at a year when the Fed looks to move in the opposite direction and start removing restraints, could create scope for substantial repricing, meaning a drop in the pair. Of course, big impact could be in store for the stock market as well. Now on the right, you can see the monthly chart of the main Japanese stock index. Let's actually make this bigger. Because the main index recently reached record highs, which surpassing the 89 peak, largely due to the loose monetary stance and the subsequent yen depreciation, which has bolstered foreign inflows. The BoJ's tightening cycle back in 1819 and 1990, you can see that on the left of the chart, had actually led to a substantial reversal after the then record highs. So you can get a grasp of the potential ramifications. The rally these times, of course, seems more, let's say, solid, as it relies on structural changes and on investor-friendly measures by the government. And even if the BoJ begins tightening, it's unlikely to tighten as aggressively as it had done back in 1989, 1990. So that's pretty much it from me for today. We will talk again on Tuesday, 10 minutes before Wall Street opens, with the outcome of the BoJ decision, and we also expect the RBA in a week that also features the Fed and the Bank of England, but we will talk about those on Tuesday's session. That's it from me. Thank you for joining me.